All right, guys, listen up. The markets do not take a snow day. So look what I just plowed out. It's the New York Stock Exchange Einstein.
School's back in session, everybody. Let's
give
go.
it-
School with the Vaz. Your favorite teacher, that's for sure.
We're going to have class today, and we're going to have an AM to PM class. So starting with the AM, Peter, futures. What are futures?
So what are the futures? So you have the SPY, the Spider Index, okay, which is the S&P 500 stocks. You've got those that trade in actual time, which is an index of 500 stocks that are traded here in New York and on the NASDAQ, okay? But then you have the futures on the SPY, okay, which we call the Spiders. Now, the Spiders can trade 24 hours a day. They're fairly active trading, and they will trade relative to what oil's trading, what the futures are, what commodities are doing, what bonds are doing, and what happens geopolitically around the world after we close. So our market, I believe, is a preemptive market, the New York Stock Exchange. We used to be 80% of the market volume. Now, over the years, through deregulation and whatnot, and the creation of these electronic trading platforms, we've seen many platforms trade. So we only now do 10 to 20% of the volume, which is unfortunate for us. But at the end of the day, what goes on here in New York, even though the volume is not as much as it used to be, just because it's the NYSE and because it's New York City and it's this room and this iconic place, it will affect what happens in the world trading going forward. As we see that when Europe closes, we will get some stock layoff business from them. What happens here going forward around the world will be affected by what happens here. Whether it's earnings related, Fed related, commodities, oil related, whatever happens, this is just a world market. But what's different about these days is that markets trade 24 hours a day, so that there's more opportunity for people to make a bet on what the futures are going to be. Let me give you an example. Everyone bet during the election last year that if Donald Trump were to become president, that the market would be down 1,000 points, okay? People were fearful that him coming into office, and this is all projected, right? At the time, that night, right, he was elected at 3 o'clock in the morning. The futures, which were trading, did sell off 1,000 points. Pre-market, in the middle of the night, upon the election. Now, that could have been any number of reasons, but basically everyone had made such a big bet that if he wins, we would be down. They started selling it. And once you get this reactive thing and you have algorithms and you have high frequency and you have whatnot, things sort of fulfill that prophecy. And the market did go down 1,000 points. But once people started to die, the funny thing about futures is it's an impulse, it's an emotional reaction. It could be based on reality, but by the time we opened that next morning, we were actually up 1,000 points. So that whether people were covering their short that they had made the bet overnight, whether people were realizing that, maybe this isn't a bad thing. And so, for every buyer, there's a seller. So for everybody who's betting that the market's going down, there's somebody who's betting it's going up. So that's the funny part about futures so it adds a lot of new dynamic to the market, and it's a fascinating thing. So it's another instrument to trade. It's a fascinating instrument because it's based off of 500 stocks. It actually moves the market in a big way. And lately, what we're seeing with volatility coming back into the market is that the volatility in the futures fuels volatility in the actual everyday common stocks. And you end up having the days that we've been having, which in my opinion are incredibly exciting.
And it really is. It really is. Now, when we're referring to futures, we can refer to some of the points that are made as handles, correct?
Correct. I mean, handle, it's just a term. I mean, you're looking at intervals of 10 cents or $1, whichever one of the future financial instruments you are trading, right? Because there are many of them. There's UVXY, SVXY. These are triple volatile short and long positions. There's the SPY. So there are a bunch of different ones, but a handle is just a term. I mean, the market, now that you mention a handle, the futures just spiked a bunch of handles. As you'll see, it goes up. So I think it's a 10-cent increment or $1 increment.
Yes, I've seen that on the big board. I'm glad that you pointed that out. Now, the market's about to open, guys, and all of a sudden I see, this is theoretical. We are trading right now. Fair value or implied open. What is that, Peter?
Okay, so everything here is based on where the markets, even though markets are trading 24 hours a day, things are based on where the markets close or where the markets open. So let's say last night the market closed at 100. Let's just for a given number. And whatever happened overnight, earnings came out, stocks that drag on the Dow or whatnot were Walmart's up or down big, Boeing's up or down big. Things happened in treasuries. There was a bad auction. There was some kind of a geopolitical disaster. There was a terrorist attack. Something happened out of Washington. And the market futures reacted. So the SPY, the Spider Future Indication, is either down 100 or up 100. The market of equity market is not trading, but the futures market is trading based on what happened overnight is going to affect the market negatively or positively. And the futures instrument is trading down or up. So if the futures instrument is trading down 100 points, that will imply that the Dow Jones Industrial Average will open around down 80 points. That's just a number. I'm not a mathematician, but that's how it works in my head.
Understand. Okay, now let's move on to the trading day. And then it's kind of near the close. Dow is up, let's say, theoretically, 100 points. But then all of a sudden, Art Cashin comes in and says, guys, there's 2 million for sale market on close orders. What the heck?
Stocks open at a price due to a supply and demand of stock, and stocks close at a price due to supply and demand. These order flows come into the market before the market opens to create the opening of the market, right? People who want to be involved on the opening of the marketplace will put in buy 5,000, sell 5,000, buy 50, buy 100,000, and they'll put it in the opening template to be represented on the opening of the market. When the bell rings and the stock opens at a particular price, due to supply and demand, they will participate. Their orders will be completed. On the close, the same thing happens, but the order flow comes in not at one moment, but it comes over a 2-hour period of time. So starting at 2 o'clock, people start putting in their interest to participate in the closing trade. Now, why is somebody going to do that? If somebody has 1 million shares to buy and they want to be basically an average over the day, they're going to buy in a market that is as volatile as we're seeing it. We were down 100, we're up 100, we're down 100, we're up 100. You want to basically be able to explain to your customer why you did what you did over the day. You can't put all your eggs in one basket. You don't want to step into the market 100% with your order flow unless that's the customer's decision. So what you do is you may buy some on the opening, you may buy some during the day, and you may buy some on the close. That way, if the customer says, what'd you do? You said, well, I participated at every level. Okay? So that creates the opening template is what people's interest is on the opening. During the day, the market trades because of people's interest throughout the day, whether they want to buy it aggressively, passively, 10%, 20%. And then on the close, people also participate on the close to average their price on the day. Okay, so at 2 o'clock, people put in their interest to buy and sell on the close. That goes into a big pool, which is executed on the same bell as the opening bell on the close to participate there. So if I have 1 million shares to buy for a customer and I bought 300,000 on the opening and I bought 400,000 during the day, I'll put in 300,000 to buy on the close, and then I will have been represented throughout the day. What that tends to do is that creates a nice volume close. In some cases, depending on whether it's a quad witch or a rebalance day on the S&P or one of the indexes, or on a regular day where there's a lot of flow coming in and out of the market, you may see huge volumes, and you may in fact see spikes or sell-offs in the market due to that interest. So that's a market on close order.
If it's for sale or to buy, does that implicate anything for the next day?
No, it doesn't. Surely doesn't have an implication on the next day, but it may have an implication on the day that it happens itself.
Gotcha.
Okay, so depending on what it is to buy or sell, it's a fine-tuned machine that there's no way that you can. There can be big to buy and the market can sell off. There can be big to sell and the market can rally. Sometimes the market is a lot stronger than the market on close orders. So it's just basically an indicator on what's going to happen in a particular stock. sometimes all the planets set up, and Aquarius aligns with Mars, and it's all good, and you can think it's going to be to buy, and it goes up. It's no guarantee. Don't put your eggs in that basket.
And he's an astrologist too. Well, Peter, thank you so much for pointing out the stars for us, giving us class today on this snowy one. Thank you for coming in and your time, my good man.
Next Wednesday. See you later. Thanks, guys.
Have a nice school day, guys.
Bye, guys.